Dropbox this year has been a big winner for me. It's currently up 37% for the shares that I still hold. I did book several $1,000s in profits earlier this year when I initially held about 1,500 shares of this company. I now still hold about 700. Now, this company did just report its earnings, and that's what I wanted to cover in today's video. For today, if any one of you are watching this video and you might be wondering about investing in this company, or you've been investing alongside of it with me over the past year, this is the video for you because this is going to give you a quick update on their earnings and whether or not this is one that you should be holding going into the next year. Now, for me, this is one that I have trimmed my position by about half, slightly under half, but I don't plan on selling any more shares until we get to at least 30. I plan on fully exiting my position entirely around 35-ish dollars a share. Probably 35 as well, end up selling it all, more than likely if it gets there in the near future. If it takes a long time and we buy back more shares and the company is worth more and they're still growing the way they should, then it might end up being higher, around $38, $40 a share, but we'll see where that goes. Now, this company does make up still a pretty considerable amount of my invested net worth. Right around 30% is just in Dropbox, and we still have around a $20,000 position in this company, $19,845 to be exact. Now, this company did just report their earnings, and we're going to give the bullet points of this. We're going to talk about the free cash flow, the revenue, the long-term targets of this company, and how much stock this company is actually buying back every single quarter and every single day, and how it will affect you as a shareholder. But other than that, guys, it's going to be a fun one. I'm still doing mentor sessions. Prices start at $50 per hour, where I can help you start your investments, just talk about your financial goals, if you want to just meet me in general, all types of things that we can go over. People love these, so if you're interested in that, check all that stuff down below. But other than that, let's go ahead and get started by looking at some of the past history for Dropbox. Now, we can go over their strong performance at scale, a little chart here that they have over the last couple of years. You can see that they're generally growing free cash flow, they're growing their revenue, they're growing their margins, and users and ARR, annual recurring revenue, is growing in the right direction, and annual revenue per user is also growing in the right direction. Now, that's great, but I want to talk about specifics. Why is this company still growing? And I think it's very easy because people like to talk about fast-growing companies all the time. People like to talk about the NVIDIAs. Oh, NVIDIA just grew this much. They're expected to grow this much over the next year. Or, oh, this company is planning on growing so much, like one that I'm interested in, one that's growing big time. Just over the last quarter, they grew about 30%. CrowdStrike, it's exciting. And people don't like to look at Dropbox because it's a very boring company. They grew revenues only 8.7%. And I think it's so easy and so simple to discredit a company like Dropbox because people are saying that it's done with growth, a company that can be replaced easy by a Microsoft or another big tech giant, and that might be true, but I don't expect this company to put up incredibly high numbers. In fact, I don't need them to put up incredibly high numbers. What they're doing right now, between 5 and 10% growth, is exactly where I want them to be and right where I need them to be to make money on the stock over the next 6 months, over the next year, 2 years. Because if you look at this, total revenue was $622 million, which is an increase of 8.7%. Now, that's pretty decent growth, but the main reason that they're able to do this is because of two reasons. 4% came from paying users going up, so 4% more people used them this year than they did last year. They grew the users from 17.37 million up to 18.04 million, about 4% growth. And then what about revenue per user? Last year they were paying an average of $133, now they're paying about an average of $139. Once again, about 4% growth. Now you take 4% more users, each user paying about 4% more. There you go. There's your nice handy dandy 8% revenue growth. It's very easy. Now, as they raise those prices, their existing customers, they're still using the same products for, which means they're getting more profitable. Now, speaking of profitability, the long-term targets by next year of this company is to hit $1 billion in free cash flow. This year in 2023, they're projecting a little over $800 million in free cash flow, and they're projecting to hit $1 billion next year. Now, that would be pretty considerable growth. I don't know if they'll actually get there. That's a bit too bullish in my opinion. I think they'll probably be closer to somewhere around $900 million, but nonetheless still impressive given that this company's size is relatively low with a market cap of under $10 billion. And keep in mind, this says under $10 billion when this company was $20 a share just 6 months ago. This company actually reached a low of the 18s, and now the company is almost 30. So this company has recovered quite nicely, well over 50% from its bottoms, and it's still under a $10 billion market cap, and they're projecting $1 billion in free cash flow next year. share, 10% of the company's size and profitability within the next year. Now, will they get there? Now, this is something I wanted to look at because when you look at the charts for free cash flow year over year, it doesn't look that great. This is the one part that I think investors look at, and initially it looks like a bad line item that you may get confused by. Let's see last year. What did they do? During this quarter, they did $206 million in free cash flow. So you would hope for a positive number, but it actually shrunk over 10% down to 184.6. Now that would be a huge red flag to me. That would be me saying, oh my gosh, this is going down double digits year over year. Profitability is in the toilet. What's going to happen for a company like Dropbox? Well, I'm highlighting here in blue the issue with this one-time exception. Cash flows in the second quarter of 2023 included $34 million of expenditures related to the reduction of workforce. Now remember that this company did just lay off a bunch of its staff. And you can see from its G&A, which is general administrative expenses here in this pinkish kind of salmon color, you can see that last year it was $55 million. And it's once again going up to $60 million, but these are one-time layoff costs. These are severance packages, these are issuance of stock, these are bonuses that they're paying out. All these one-time costs eat up about $34 million in cash flow. Now, if you take this and you add another $34 million back, it would actually be somewhere around here where my mouse is, right around these numbers, right around 220. Now, if you compare that versus the last year, they still grew profitability quite nicely. So if you take the 184.6 and you add 34 to it, and you compare to last year's 205.9, you can see that they actually grew profitability. If you take those one cost away, they grew profitability over 6%. Not bad at all, considering that this company is priced so low. So this is what's interesting here. This company is still growing revenue pretty decent. It's still growing profitability pretty decent when you take away those one-time costs. However, this company is not perfect. It is a company that, in my opinion, can be replaced. But the reason why I think I'm going to make money over this stock over the next year or so, and the reason why it's continued to make me money, and part of the reason why I've had outperformance this year, is primarily due to the reasons of this company buying back so many shares. Right now, keep in mind that over the last quarter, this company bought back around $150 million. And over the last year, they've been buying anywhere from around $150 to $175 million every single quarter. Now, keep in mind, over the last quarter, they bought back 5 million shares outstanding. And this has been a trend consistent over the last couple of years. They've been buying back 5, 6, 7 million shares every single quarter. If you literally take 5 million shares and you divide that by 90, and keep in mind this is not trading days, I'm just using calendar days over a quarter period, this company is buying back over 50,000 shares a day. Imagine if every single day you woke up, 8:30 Central Time, the market opens up, and you put in a buy order for 50,000 Dropbox shares. That is essentially what the company is doing every single morning, and that's why the companies went up 6%. 6%, down, I should say, down rather, 6% in shares outstanding year over year. So let's do some quick math here. Let's make things very simple. If you've owned Dropbox over the last year, profitability, other than those one-time costs like we talked about, has grown around 6%. And also, how much shares have they bought back in the last year? Well, they bought around 6%. 6 plus 6, that means that you've owned about 12% more profits this year than you did 1 year ago. And this is the reason why I don't want to sell this company. With this company still projecting around $800 million of free cash flow this year, you can see that this company's market cap is nothing in comparison to where this company's size and scale is at. Now keep in mind, if this company is trading at $9.7 billion and they're projecting around $800 million in free cash flow this year, its price to free cash flow is around 12. Now, considering that the market generally trades a lot higher than that, I don't think it's a bad deal at all to even still own this company despite me being up over almost 40% on it. Now, it's very easy to look at those gains and think that the company's overvalued, but honestly, I don't even want to keep trimming my position until we at least get to 30 when this company starts to get to around a 13, 14 price to free cash flow for this year. And next year, the numbers will be even better, and I don't even want to fully exit my position in this company until we get around 35 for that exact reason. That's why it's around 30% of my invested net worth. That's why I hold this company. And I think the next quarter will be even more profitable than the one after that. And more importantly, they'll buy back shares, so you'll own more of the company, whether they grow revenues or not, which will give you more equity as an investor. Other than that, guys, thank you so much for watching. Check out the mentoring sessions down below, but I'll catch you all next time.